Hi, welcome to today's webinar, Finding Product Market Fit in FinTech. I'm Gabby Abubba, Growth Marketing at Atrium, and your moderator for today. Before I get into webinar logistics and introduce our speaker, I want to tell you a little bit about Atrium. Atrium is a corporate law firm and technology company providing fast, transparent, and price-predictable legal and business services to startups through our technology platform and innovative subscription-based pricing. Atrium's reinventing how professional services are delivered with the focus on improving the client experience. Founded by Justin Kahn and backed by Andreessen Horowitz, YC, General Catalyst, and more, we're trusted by over 400 of the top startups and hyper-growth companies in and outside of Silicon Valley. Now on to logistics. This webinar will be roughly 45 minutes of content and Q&A. Feel free to submit questions at any time during the webinar on the left side of your screen. Our speaker today, Mark, is willing to try to answer some of the questions as he goes through the content, but we'll also have a portion at the end specifically for Q&A. Now I'll pass it off to our speaker, Mark Roszak, to introduce himself and dive into the content.
Great. Thanks so much, Abby. So I'll spend some time here giving you my bio. But as Gabby mentioned, I want to make this as useful as possible for you all. So please submit as many questions as you have. If there's any topics on the front end that you'd like me to chat about or discuss, feel free to submit those now. And really want to make this about providing value and making sure that your time here is useful. So started my career in DC working for FINRA, the Financial Industry Regulatory Authority, worked in the Office of Fraud Detection and Market Intelligence in sort of a market regulation function looking for insider trading and other sort of market manipulation type activities. Thereafter, went to the international law firm of K&L Gates in DC, where I did a mix of financial services policy work and traditional financial services legal work, representing broker-dealers, investment advisors, money transmitters, and the like. Then made the move out west here roughly 2.5 years ago to work for an early-stage FinTech startup in sort of pre-IPO share space, and then came over to Atrium roughly a year and 2 months ago to join the FinTech and blockchain team here as sort of regulatory counsel. So give you a quick background on the FinTech and blockchain team. As the name would suggest, we focus on providing legal services to FinTech and blockchain startups. And so, we generally provide legal services to, Series B or earlier companies, but have certainly provided services to some unicorns in San Francisco and Silicon Valley here. So that is me. I'm glad that part of talking about myself is over. So we'll jump in to sort of an outline of what we're going to talk about today. Initially, we'll discuss developing a regulatory strategy and then get into the uniqueness of product market fit in FinTech and talk about, bringing product to market, the costs associated with that, and, how you can sort of implement a regulatory strategy that makes sense for sort of the unique, process of having to bring this regulated product to market. And then also lastly, we'll touch on avoiding easy compliance mistakes. And there's a number of stuff that goes in there. And then we'll end with a Q&A. But again, if you have any questions, throughout the process, feel free to submit them. So developing a regulatory strategy, we always suggest for early stage companies to develop a strategy before you start building. I think the idea here is that you don't want to start building and then get into a situation where you recognize that maybe you're a money transmitter, maybe you're a broker dealer, maybe you're an investment advisor, and the way you've structured your product just doesn't make sense. And so, I hate to be the bearer of bad news, but we've certainly seen it with early stage startups that we represent, where they come in with an idea, they built some product, and then, based on regulatory concerns, they need to significantly amend that product, and as such, rebuild portions of their product. Another thing that I would note is as when developing this regulatory strategy, make sure it's done with an appropriate party, whether that be an advisor, a lawyer, a consultant, or the like. Certainly there's tons of nuance to this FinTech space. And so, I think having a decent idea on your own as far as, what that regulatory strategy looks like, it's always good to get multiple perspectives, because the time and cost, both from a bandwidth and from in a monetary perspective, can be significant if you're sort of pursuing a strategy that turns out to be the incorrect strategy. One thing that I think, a lot of founders do, and I generally endorse, although I would qualify it with the fact that it should be, you shouldn't take anything as wholly, but look at what other similarly situated startups have done. And we know that I see this often with early stage founders to say, hey, I'm doing a Robinhood, or I'm, doing a Venmo or whatever it is. And so they've sort of like taken lead from some of those other companies that are similarly situated and tried to understand exactly how they've structured things. One thing that I would hesitate to fully endorse that is that often, things change. Thinking of Robinhood in particular, early on in their existence, they didn't have their own broker-dealer license, and they used a third-party broker-dealer. And so if you looked up what Robinhood was doing now, you would see they have their own broker-dealer, and you may say to yourself, hey, great, Robinhood has a broker-dealer. I want to offer brokerage services in this unique fashion, so therefore I'm going to go ahead and get my own broker-dealer right off the bat. And certainly that would be one strategy, but probably not the strategy that we would suggest in a short-term basis. Lastly, I think there's an understanding, at least, and I always want to set expectations for founders that you are bringing likely a regulated product, and we'll get into later to like potentially products that are not regulated. And there's certainly a number of those out there, but you're bringing generally a regulated product to market. As such, there's a bunch of hoops to jump through. It can be difficult. You're going to have to make sacrifices likely on the UX UI side, and you're probably not going to be able to build it exactly how you want. So I always like to set the expectations on that front. And I always remember someone telling a story about CS or computer science 101 at Berkeley here in the Bay Area. And I don't know if this is true or not, but I've certainly heard it that their first assignment is to build Instagram version 1, right? And so having not had much exposure to computer science, they're able to build that. And so contrasting that against a FinTech startup where that'd be literally impossible, just because of the complexities around the entire infrastructure, and particularly the regulatory aspect of it. So now we'll get into the uniqueness of product market fit. And what I've done here is sort of put the different products in different buckets here. So initially, we'll cover money transmission, then we'll get into brokerage and broker-dealer activity, investment advice, and then also banking products, which is sort of like a catch-all bucket for a lot of different activities, whether it be issuing debit cards, allowing individuals to set up bank accounts and the like. So we'll start here with money transmission. I think it's always helpful to explain, give an example of what money transmission is. And so on the front end, it's acceptance and transmission of funds. And so there's a lot of nuance there. And we often get folks who are coming in who are asking, well, am I actually transmitting these funds? Maybe I'm sending it from one user's bank account to another user's bank account, the same user. So it's not sort of Venmo in the sense I could send money to Gabby, just maybe moving money from my Chase account to my First Republic account. And so there's a lot of nuance to what acceptance and transmissions of funds look like. And I would say of any of the topics we'll cover today, this can be sort of the most difficult to grasp. I mean, if you take a step back, and we've seen this with some well-known startups that have obtained money transmission licenses that you wouldn't traditionally think would be money transmitters. I mean, when I think money transmitter, I think Western Union, I think Venmo, but also, what does Uber do? What does Airbnb do? I mean, at the heart of Uber, a large function of that is transmitting money from rider to driver, right? And so, technically, Uber is accepting and transmitting funds, but are they a money transmitter? Do they require registration on the federal and state levels? And so that's the highly nuanced questions, and the devil's in the details. So I would suggest of any of the things we're going to talk about today, that this would be the one area that I would suggest seeking legal counsel, because it can be too difficult to work through. Also looking at a company like Airbnb for a long time operated without money transmission licenses. And again, what does Airbnb really do? They facilitate the transmission of money from renter to rentee, I guess. And so there's certainly not a lot of nuance that there are numerous exemptions, both at the federal and at the state level. Some of the more well-known exemptions are the payment processor exemption and also the goods and services exemption, which is often applicable when it comes to providing, it often applies to startups that are engaging in money transmission as some part of their product, but it isn't what they do. It isn't a Venmo where, the whole purpose of Venmo is to transfer money from one individual to the next, where if the transmission of money occurs as part of a larger good or service that's being offered, then there's the potential that it wouldn't be regulated as money transmission. As you see here in the slide, the process for becoming licensed at the federal level and at the state level is significant. I mean, I put 500,000 here. We see numbers double that, and certainly there's a lot of different aspects to it. Just sort of on a high level, some of the costs for registering as a money transmitter are going to be any legal or consulting costs associated with actually putting together the applications. We see some people do that in-house. Some people, hire law firms like Atrium or hire consulting groups to assist in that process. And then also the application fees for potentially all 50 states or 49 states, because Montana doesn't regulate money transmission. And then there's also a surety bond requirement, which is essentially a requirement of any state money transmission application that you obtain one of these surety bonds, which is almost like an insurance for consumers, that if somebody absconded with funds, that the consumer would be made whole. And so this surety bond requirement is comes to bear in sort of an annual fee of anywhere from 1% to 3% of the surety bond requirement, so it can get significant pretty quickly. And so when you start adding up all these costs, they can get pretty significant pretty quickly. One thing I would note as well is that, after registration, not only on the federal level, on the state level, but it's almost a requirement that you have a compliance function. Whether that compliance function is in-house or you sort of outsource that is something that we can talk about, and I'll certainly get into. It's something that we help folks think through. It's difficult when you're building a company and you're worried about marketing and growth and all these other functions and operations and tech to also sort of potentially add in there building out a compliance function, and what does that look like? We often get questions as far as individuals who, hey, can I serve as a chief compliance officer? I have XYZ experience, and I'm also the CEO, but I think I could act in this capacity. And generally, there's not a hard and fast rule on that front. It's going to be facts and circumstances analysis as far as what's the experience of that individual, and then also really the most important factor that not only folks will look at the state but also the federal level is, does this individual have the requisite time to actually spend running this compliance function? And so that becomes a difficult thing for folks to think through, particularly early on. Pre-launch, we often see individuals designate one of the founders as the chief compliance officer, but post-launch things change. Founders, whether they're CEO, COO, head of growth, head of product, whatever it is, it's hard to make an argument that they have the bandwidth to also run a compliance function. And so, depending upon what product you're bringing to market, if you're maybe onboarding a couple of clients a day, I think you can make an argument that an individual like that would have the time. But a lot of these direct-to-consumer products, the idea and the hope is, and often is the case, that they'll be onboarding thousands of clients a day. And so it's just not feasible to suggest that someone who has, a job that probably takes up 40 or 50 hours a week also has the bandwidth and resources available to dedicate to that compliance function. And so, there's a couple of options there. You can either hire a compliance officer, or there's options as far as leveraging outside consultants. And so, sort of depending upon, what that launch strategy looks like, what the long-term goals are, could make sense to hire a compliance person on the front end. But we often see individuals and startups, get the outsourced compliance function for maybe the first 6 months to a year, obviously depending upon circumstances and how big the compliance burden is. but then thereafter, going and actually hiring someone to run that compliance function and building out that whole program. Lastly, and sort of my favorite bullet here is partnership options. And, obviously for startups, maybe raise a seed round of $2 or $3 million. The idea of spending 500,000 of that on obtaining regulatory licenses is the non-starter. And so there's numerous partnership options, and this is often where we're assisting individuals, depending on what product they're bringing. There's a number of people in the market, whether it be a prime trust, a wire, whether it be, other money transmitters that can assist with lack of a better term, renting their license. And there's a couple of ways that can actually occur. And the devil can often be in the details, because partnership doesn't necessarily mean that you're not going to fall into the money transmission bucket. But if it's structured properly, it certainly can. One thing that I would note is, it often depends on how this is structured, in the sense, if I'm building a product that is just sort of the UI for a back-end financial institution, what sort of account is created in that financial institution? Is it a custodial account, or is it an FBO account? And that's often a determining factor. If it's a custodial account, that often means that the startup itself won't have access to the funds. And it gets back to this idea of, if you don't have access to the funds, then you never accept the funds. And as I noted before, money transmission requires acceptance and transmission. You have no acceptance, then you're not going to meet that threshold. But often, sort of an FBO structure, it'll be held in the name of the company for benefit of the client. And as such, with that structure, the company would have discretion over where those funds are, what happens with them. Are they sent? Are they not sent? Are you making investments, whether it be crypto or something else? That to me looks like acceptance. And I think that's, generally accepted, that an FBO account is going to mean acceptance, and then likely acceptance and transmission. So I would hesitate to put any sort of blanket statement out there as far as partnership options, and making a statement that if you partner, then you definitely do not need to register, because the devil's in the details. And as I mentioned, we often help folks sort of think through these issues early on. So that's sort of a good overview on money transmission. Again, if you have any questions, feel free to chime in. So next slide here is we'll talk about brokerage, or broker-dealer activities. At a high level, broker-dealer is affecting securities transactions for the accounts of others, or your own account. I think often in this space, it's going to be for the account of others. And again, as I noted before, and I think it's sort of the 800-pound gorilla in this space is Robinhood. And so obviously, as I mentioned before, when they first launched, they did not obtain a license themselves, and they were able to leverage a back-end third-party broker-dealer company called Apex, which essentially has a suite of APIs for anything that it would need to be done as far as opening an account, making trades, pulling account data, and the like. So they were able to just build a technology which sat on top of this back-end broker-dealer that allowed them to not need a license, but still be able to bring product to market. And I think that that's a theme that constantly comes up when providing legal services to FinTech and blockchain startups, is that there's always a give and take. And early on, I think it often makes sense to go the partnership route. Again, sort of taking a step back and looking at the whole idea of this presentation is finding product market fit. And obviously, I don't think it's an advisable strategy to spend, whatever it is, 50 grand, 100 grand, 500 grand, obtaining a license to bring product to market when you're not, 100% sure that you have product market fit. And so, if you can partner there on the front end, that's generally advisable. There are companies out there where they're in the business of providing services to startups, whether it be, an Apex, Drive Wealth, or there's numerous other individuals, a Marqeta in the banking product space. And so there's certainly a number of options out there. And one of the exciting trends that I think has occurred in the past 5 or 10 years in the FinTech space is it's less capital intensive than it used to be. Certainly more capital intensive than bringing a non-FinTech product to market. But I think that, these services have created a situation where you're seeing more products being launched. So we'll jump into sort of the nitty gritty here on brokerage activities or broker-dealer activities. Sort of from a high level, it requires registration with the Securities Exchange Commission and FINRA. The registration process with the SEC is relatively straightforward, but one of the requirements to actually launching is obtaining membership in an SRO or a self-regulatory organization. And so, back 20 years ago, that meant you could have gone to NYSE, NASDAQ, and the like, because those are SROs. Now, FINRA has sort of positioned itself as the SRO for broker-dealers and is really the place that generally folks are going to obtain that SRO membership. So the registration process with FINRA is significantly more involved. It can take anywhere from 6 to 9 months, potentially longer. I think a lot of folks often rush to get that application in, and I always hesitate and advise, making sure you've dotted all your I's and crossed all your T's before you submit, because you may feel good about submitting, before that deadline you imposed upon yourself, but you're going to end up paying for it on the back end because these applications are thoroughly vetted. There's, when you submit, your application is given to an analyst in-house at FINRA, and it is their job to ensure that the application is sufficient. And in my experience, you'll never get a situation where the application will be perfect first time around. I've never heard it. I don't think it exists. The analyst's job is to poke holes in the application and to ask questions and to make sure that they're doing their due diligence. And so as such, you're going to get a handful of questions on that. So, similar to the money transmission aspect that we just talked about, brokerage aspect requires a compliance function. It can be a bit more onerous than the money transmission compliance obligations. One, similar to the money transmission compliance obligations, you have AML obligations, and something that we'll get into later. But anti-money laundering obligations, which requires that sort of an initial compliance review to ensure that individuals are not on one of these OFAC lists or associated with some sort of activity and the like. And then it also requires an ongoing process of transaction monitoring and making sure that you're checking individuals against these lists to ensure that maybe somebody, when you onboarded them, were not on one of the lists but has subsequently been added. And then there's also requirements for filing SARs or suspicious activity reports to the federal government if you're seeing some sort of suspicious activity. So that's a requirement for both money transmission and broker-dealer brokerage activities. But brokerage activities have to comply with FINRA rules, which there are many. They are somewhat straightforward in the sense I think FINRA has done a good job of ensuring that it's in sort of plain English and easy to digest, because they operate for the purpose of protecting investors and ensuring that companies can actually comply with their regulations. And so as such, they try to make the rules as straightforward as possible, but it certainly requires somebody who has that experience to understand what that means and how to operationalize a lot of those requirements. And so similar to the money transmission aspect, this would setting up a broker-dealer would require having that compliance function and having a compliance officer that has the requisite experience. It's probably going to be slightly different experience than you'd find for a compliance individual in the money transmission space. They would likely have broker-dealer licenses, whether it be Series 24 or the like. And so we often see folks employing a similar strategy to the money transmission strategy, in the sense that maybe while they're submitting their application and shortly thereafter they will have an outsourced chief compliance officer. But at some point, and as you know, the user base grows, it makes sense to in-house that function. So again, here, similar to the money transmission space, you know, there's opportunities for partnership, and you know, the first two companies that come to mind are Apex and Drive Wealth, which, you know, again, you know, have broker-dealer licenses and then have built out a product that has a suite of APIs that allow companies to build to and to do all the necessary functionality that one would want for a brokerage account, be open account, fund account, make trades in account, pull historical data, and do all the sort of traditional functionalities that you'd see from your old line Wall Street brokerage accounts. So the compliance function, or those partnerships certainly come with a compliance burden, and there will be a compliance check prior to launch where they'll want to look through product, they'll want to look through your terms of service. And so I'd advise, you know, seeking sort of either legal counsel or some sort of consultants to ensure that has been thoroughly vetted before the actual launch, because it will end up coming back to potentially slow down that compliance test prior to launch. Another aspect of this, of launching a brokerage product is, you know, sort of the cost and fee structure. You know, as I noted, it says here in the slide, the registration process can take 6 months or more and cost, you know, 50 grand or potentially more, depending upon how you're structuring it. And so the partnership opportunities also come with their own sort of cost and fee structure. There's generally, you know, either transaction-based fees or an AUM-based fee. And so the cost for those individuals or for that functionality can often be pretty high. And so that's why we've seen, you know, take again Robinhood as, for example, they initially launched where they were leveraging this third-party back-end broker-dealer, but thereafter they obtain their own broker-dealer, and it becomes really like an economic decision at that point. And obviously, there is a sort of a legal compliance concept there as far as like wanting to ensure that you have the requisite resources to devote to the legal and compliance burden of actually obtaining the license itself. But that would generally be just sort of an element in making that economic calculation as far as we're paying XYZ to this, you know, third-party back-end broker-dealer, and that's costing us whatever it is, you know, 500 grand a year. And so if we can go and obtain our own broker-dealer license, that will cost us 50 grand a year. We'll have to hire some compliance individuals who will cost us X. And so we think, you know, we're in a position now where it makes sense to obtain our own license. So next we'll move to investment advisor, which hasn't been quite as active in recent years as it was maybe 4 or 5 years ago with a Betterment and a Wealthfront and a Stash and an Acorns. But I have seen, you know, sort of AI start creeping in to this field here. And so I'll give sort of a quick overview, but want to leave some time for questions, and then also, you know, to sort of get into the banking products, because I think, you know, certainly at Atrium here, we're seeing a lot of inbound from folks who want to sort of start, you know, want to offer a sort of a banking type product to individuals. And so I want to leave time to discuss that. And again, if you have any questions, feel free to chime in. Happy to do so. So at a general level, an investment advisor is required to either register with the states or the SEC. This can be sort of a difficult process and would generally require legal counsel to determine whether you are able to register with the SEC or you have to register on a state level. And I think people generally see as, you know, SEC registration as a bad thing. In the investment advisor context, it's the best case scenario. If you register at the SEC, then you don't need to worry about, you know, having clients in XYZ states, and the idea being if you take a certain amount of clients in Michigan, for example, then you'd need to register with Michigan's, you know, the appropriate regulator in Michigan. And so having that SEC registration gives you the ability to service clients in all 50 states without having to worry about, each state's regulatory regime when it comes to the investment advisor. And so, one of the well-known, ways that companies are able to register with the SEC is the Internet Advisor exemption. And this is, sort of the way I think of it is almost the robo-advisor exemption, because a lot of the well-known robo-advisors, a Betterment, Wealthfront, Stash, and Acorns presumably use this way of registering with the SEC. And so it requires that, you're not providing personal advice through email or phone communications with individuals. And so you're just providing sort of an internet product. And I don't want to say it's impersonal advice, but it's certainly not directed at individuals, and often requires folks putting in, their risk tolerances, their investment horizon, and then as such, getting sort of a suggested portfolio of investments. Again, if you're registering with the SEC, the registration process can be relatively easy. I would note there will be an audit. You will have, if registered as an SEC or even a state registered investment advisor, there will be an audit at some point. When it happens, you can never say for sure, but it's one thing to be mindful of. And, that goes for all the buckets of regulated entities that we're talking about. There will be an audit function. And so I just, counsel folks to be mindful of that, to make sure that, they're keeping records and they have sort of a sufficient record keeping and compliance function that when, the appropriate regulator comes in to look at their books, they can, not only show that they have the policies and procedures, but they can also show with demonstrated emails or notes to file or memos, whatever it is, that those compliance functions were actually implemented. And that's where we see, big, sort of the most difficult aspect of implementing any of these compliance functions is actually doing it. It's easy enough to pay for an AML policy or to pay for a compliance manual for an investment advisor, or broker dealer, but the difficult aspect is actually implementing it, and that's really where the audits are going to be focused on. They will certainly review the compliance manual, the AML policies and procedures, but they want to show that, and you want to be able to demonstrate that you've actually been implementing those. So in the investment advisor space, the compliance obligation requires a number of things, making sure that disclosures are accurate, any proprietary trading by you or any individuals at the firm, safeguarding of client assets, making sure that there's accurate creation of required records, safeguards for policy of privacy information, trading practices, and then also a business continuity plan, which is something that you'd see in the broker-dealer space as well. So making the jump to banking products, and as you'll see here, it's sort of a sparse slide, but there's sort of such a wide variety of banking products that can be brought to market that I didn't want to sort of clutter this slide up. Other than state, there's a complex overlapping regime of state and federal regulations. And I think, in my mind, it's almost a non-starter for a company to actually obtain a banking charter that's a startup. And, certainly there's been discussions about sort of this FinTech charter with the OCC, but hasn't proved to be quite as popular as individuals would hope, I think. I think generally because of a cost of capital aspect where you have to have capital reserves to make the application, and the application process is difficult. So if you're an early stage startup that's raised a couple of $1 million, the idea of earmarking a large portion of that to be a capital reserve to apply to be, to obtain some sort of banking license is a non-starter. And so fortunately, there are a number of institutions out there, and this has become something that's become very popular in the last year or so, that will allow you to leverage their license and build a product on top of that. And this is a similar situation to the money transmission situation, where you are sort of the UI or UX for a back-end banking institution, and there's a number of them out there, whether it be Evolve Bank, partnered with Snap's or Green Dot, but there are a number of these institutions out there that are willing and have built sort of a suite of APIs to allow individuals to build on top of their institution and do all the same sorts of things that we've discussed before as far as account opening, funding account, transferring money, issuing debit cards, and the like. And so, that they've really built something around and an infrastructure around being able to bring those products to market. So, I hesitate to get too deep into the banking products because there's such a large variety. But if anybody has any questions, happy to sort of discuss things more specifically. So avoiding easy compliance mistakes is sort of the last one on the list here. And so, as I mentioned before, if you're partnering with an existing financial institution, you'll have to undergo a compliance review before launch. We always advise folks, to have an understanding of the compliance requirements for this partnership institution and make sure that they're building that into product. In my experience, these existing financial institutions are not very flexible as far as, folks meeting their compliance requirements. And so, we always caution or hesitate for too much pushback on that front because the financial institution lives or dies with its license and is very mindful of making sure that they're not cutting corners. And I think, one thing that we see more broadly in the FinTech and blockchain space is sort of this tension between technology companies, which move fast and break things, and financial institutions, which just cannot operate that way for regulatory reasons. And so, I think there's often a bit of a come to Jesus moment for startups as they get into this compliance review and understand that, hey, maybe the way that they wanted to build product needs to be amended a bit to actually be able to launch. And so we always counsel to understand those obligations as best you can on the front end, sort of accept them as part of the launch, and then make sure that you're building those functionalities into product instead of trying to scramble prior to the compliance review to backfill or to change functionalities to ensure that you're complying with their review. So sort of reiterating what I said before, and if you're obtaining the licenses yourself, you will be audited. Generally, it's going to be within the first couple of years. And so, that's something that can be significant. There can often be fines associated with that. And so there can also be reputational harm on that front. And so, that's something that companies should really be looking towards sort of the first test of their compliance function. And so, always, developing that compliance function on the front end, making sure that it's properly resourced and setting yourself up for success there will be sort of a big win in the back end. I mean, we've seen folks, and I've certainly, done this myself, where it's sort of reactionary instead of proactive. And in my experience, that always ends up being more costly for the startup. So, we certainly caution against that. Again, sort of as we mentioned before, properly resourced compliance function that can take a lot of different approaches there. Again, you could either hire a compliance individual, so you can get an outsourced consultant. But really what regulators want to see is they want to see that individual is set up for success. There's certainly been enforcement actions where or audits that have pointed out that regulators do not believe that the compliance function was properly resourced. And so, you want to make sure, resources from a training process, also resources from a personnel perspective, are two things that are going to be sort of hot button issues for regulators. And again, it's somewhat difficult to give sort of a concrete answer as much as the lawyer in me wants to do so. It's all really dependent upon the facts and circumstances of how you're operating and what your compliance burden is. Again, if you're onboarding 5 customers a day as opposed to 5,000, and what product you're actually are bringing to market, the compliance obligations vary significantly. And so it's something always to be mindful of. If you're bringing a product to market that you expect to have thousands and thousands of daily users, or tens of thousands or hundreds of thousands of daily users, ensuring that there's a compliance function that actually is able to review whether it be, sending money or whether it be trades or account opening, someone who can review that process becomes significant. Another thing that I would note is be mindful of public statements. We've certainly seen this, I think of one particular startup in San Francisco or Silicon Valley here who, sort of got out in front of themselves and described a product incorrectly, and as such had to retract that statement shortly thereafter. And so, whether you're doing press releases, your Twitter account, your Facebook account, whatever it is, make sure that that you're seeking counsel, or you're being mindful of what statements that you're putting out there. You're not making promises that are untrue. You're not providing or suggesting that you're providing products that you cannot. And so, if prior to an audit from the appropriate regulator, often one thing that they will do is they will search the news and say, hey, what's in the news about these individuals? What have they been doing? Oh, they're offering a checking account, yet they don't have a banking license. Well, that's problematic. And so, be mindful of that, and certainly, make sure that your sort of marketing, public relations team understands, what it can and cannot say. And then, lastly, is have an appropriate terms of service as part of the compliance review. That often will be something that's required and will be reviewed before actually launching the product. But we suggest seeking legal counsel to do that, because it can often be difficult, particularly if you're partnering. Spelling out exactly how the partnership looks, and what the obligations are to each individual or party, and bringing that product to market can often be something that's difficult, and want to be mindful of accurately describing that. So we're getting up to 45 minutes here, and so we're going to stop and pause for Q&A.
All right, cool. Thanks, Mark. We'll give it a couple more seconds for anyone to submit questions. Again, that's on the left side of your dashboard. I know that this was also a lot of information, so this recording will be available on demand in a couple of days. You'll receive an email to the email address that you used to register in order to access that. All right, cool. So we'll let you all go. Hope you enjoyed the presentation, and thank you so much, Mark. Look out for the recording to be on demand for you to share with your colleagues or coworkers, and check out our resources page for other webinars as well. Thank you so much. Have a good day.